Welcome back to the channel, everyone. Today is Tuesday, 16th December 2025, and we have a jam-packed 24-hour cycle to dissect. After a week of major central bank action, markets are trying to find their footing. But yesterday's trading session delivered a sharp wake-up call, primarily driven by a deep rotation out of the high-flying AI stocks that have been the engine of this year's rally. We are going to dive into the major index moves, the crucial macro data that's setting the stage for the rest of the week, a key political comment that hints at future trade policy, and an update on the dynamic world of crypto. Let's get right into the numbers. The most significant story from the US trading day was the continuation of a sharp tech sell-off, particularly in the mega-cap AI beneficiaries. This pushed all three major US indices lower, fading morning gains. S&P 500 closed down 1.1% at 6,827.41. Nasdaq Composite led the losses, dropping a significant 1.7% to finish at 23,195.17. Dow Jones Industrial Average showed a bit more resilience but still finished lower, losing 0.5% to 48,458.05. This downward pressure was a spillover from late last week, where earnings from key AI-related companies disappointed. The narrative is shifting from AI will lift all boats to is the AI build-out beginning to squeeze margins? Across the pond, European markets also ended Monday in the red, with earlier optimism fading as US tech weakness set in. Stoxx 600 declined 0.5% to 578.24. FTSE 100 slipped 0.6% to 9,649.03. Asian markets, having closed earlier on Friday, were generally higher on Monday, digesting last week's Fed rate cut and looking ahead to new economic stimulus signals from China. The action was driven by a combination of economic data, investor rotation, and forward-looking central bank speculation. The biggest single-day impact came from a massive sell-off in semiconductor and software companies. The core fear is that the heavy capital expenditure required to build out AI infrastructure, things like data centers, chip factories, and related software, is becoming a drag on immediate margins rather than an immediate boost to profits. Broadcom and Oracle, fresh off disappointing earnings last week, continued to sink. Broadcom was down nearly 6%, extending Friday's double-digit loss, while Oracle fell another 2.7%. Nvidia, the bellwether for the entire AI chip sector, also saw a sharp drop before managing a slight recovery, though the sector remains under pressure. The sell-off was so severe that it created an intra-market rotation. Lululemon, for instance, jumped nearly 10% on an upbeat guidance and CEO transition news, showing that investors were cycling out of expensive tech and into strong-performing consumer names. Yesterday gave us some crucial early week data, particularly from the US and China. US Empire State Manufacturing Index. This report came in shockingly weak, printing -3.9 against an expected positive reading of +9.8. This signals a significant contraction in manufacturing activity in the New York region, far exceeding market expectations. The market reaction was twofold. Bonds, Treasury yields initially dropped on the news, as the weak data reinforced the narrative that the US economy is slowing, which could justify more aggressive rate cuts from the Federal Reserve in 2026 than they currently project. The 10-year Treasury yield held steady near 4.18%. US dollar. The dollar index fell to a two-month low of 98.30 as the prospect of future Fed easing weighed on the currency. China economic data. China released a batch of key figures that sent mixed signals. Industrial production came in at 4.8%, slightly below the 5.0% consensus, suggesting industrial activity is cooling. Retail sales missed expectations significantly at 1.3% versus a 2.9% consensus, highlighting continued weakness in consumer demand. The muted data has increased expectations that Beijing will announce more proactive fiscal stimulus measures for 2026, which is why Asian markets generally traded higher. looking past the current soft patch toward future government support. While the US Federal Reserve cut rates last week, and their policy is set for the moment, the market's attention is now firmly on the Bank of England and the European Central Bank, both of which have rate decisions later this week. Bank of England. Following softer than expected UK GDP data released last week, the market is now pricing in an 85% chance of a buoy rate cut this Thursday. This expectation is putting pressure on the British pound but supporting UK equities as lower borrowing costs become more likely. US Treasury yield curve, a technical but crucial macro signal. The gap between the 2-year and 10-year Treasury yields steepened to over 66 basis points for the first time in 2025, reaching its steepest level since early 2022. A steepening curve often suggests bond traders are bracing for future economic growth or anticipating a short-term recession followed by a boom, reinforcing the debate around the trajectory of Fed policy in 2026. A key political voice impacting the macro landscape came from within the Federal Reserve itself. Federal Reserve Governor Mirren delivered a speech yesterday focusing heavily on the inflation outlook. The most market-sensitive comment related to trade policy. The dominant narrative explaining the recent pickup in core goods inflation blames US tariff policy. I am not convinced. If I am right about shelter, disinflation, but wrong about tariffs, we will undershoot our inflation target. The takeaway. Governor Mirren downplayed the role of US tariffs in driving recent inflation. This is a significant statement because, for months, many analysts have cited the high tariff environment as a structural driver keeping goods prices elevated. By expressing confidence that housing-related disinflation will be strong enough to pull the overall inflation number down, even if tariff effects persist, the governor signaled a continued path toward hitting the Fed's 2% target. This commentary generally supported the rate cut expectation, keeping the pressure off the Federal Reserve to pause its easing cycle. The crypto market had a mixed day, primarily characterized by a consolidation phase following a volatile period of new yearly highs. Global market cap. The total market capitalization hovered just above the $3.07 trillion mark, showing a slight decrease over the last 24 hours. Bitcoin saw volatility, trading between a high of around $90,136 and a low near $87,577. As of our reporting, BTC is trading around the $89,886 level. The overall sentiment suggests the market is pausing to digest macroeconomic cues and potentially facing year-end profit-taking pressure after the massive rally this quarter. Ethereum saw slight recovery, trading around $3,146.99, up just over 1% for the period, showing a bit more resilience than Bitcoin. Altcoin activity. There were notable pockets of activity outside the majors. Solana spot ETFs continued to see strong institutional interest, attracting $33.6 million in weekly inflows, signaling diversification of institutional capital beyond just Bitcoin and Ethereum products. However, the broader layer to sector experienced declines, with tokens like TIA dropping significantly, reflecting a broader pullback in highly speculative segments of the market. Regulatory focus. On the regulatory front, news continues to filter out of the UK, where regulators are setting an official timeline to integrate crypto assets into mainstream finance by 2027, a move seen as a major step toward normalizing the asset class in one of the world's leading financial centers. As we move into Tuesday, 16th December, the market's focus will immediately shift back to the US data, which has been delayed due to the recent government shutdown. Tomorrow brings a crucial, delayed economic calendar including US non-farm payrolls for November, US retail sales for October. These releases will be pivotal. If the jobs number is weak, it will compound the recessionary signals from the Empire State Manufacturing Index and solidify expectations for further Fed cuts. If retail sales are strong, it could challenge the soft landing narrative and push back against easing expectations. The market is currently wrestling with two competing forces: AI enthusiasm versus margin reality and economic slowdown versus central bank easing hopes. Keep a close eye on the tech sector and those US data prints. That's the full breakdown of the last 24 hours. The market is clearly at an inflection point, with traders rapidly adjusting their growth and margin expectations for the tech giants. If you found this analysis helpful, please hit that like button and subscribe for more daily market breakdowns. And let me know in the comments, do you think the AI sell-off is a brief correction or the sign of a bigger bubble finally bursting?